fortress, the one place where your equity was safe from the coastal chaos. Everyone told you that when New York and California burned, the Midwest would hold the line with affordable mortgages and stable manufacturing jobs. But that narrative is dead, and in 2026, we are watching the financial bedrock of Ohio crumble in slow motion. There is a hidden crisis bubbling under the surface that goes beyond just falling prices, a crisis involving tax assessments, insurance premiums, and a liquidity trap that is about to catch millions of investors off guard. If you want to know which markets are silently imploding before the rest of the country figures it out, you need to hit that subscribe button for Tax Hack Pro right now. We do not just look at Zillow listings. We look at the tax data, the economic fundamentals, and the ugly truth that real estate agents are terrified to tell you. Today, we are exposing the 10 Ohio cities where the housing market is facing a catastrophic reset in 2026. And you need to stay with me until the very end, because the city sitting at number 1 is currently being sold to out-of-state investors as a gold mine, while the local economic data suggests it is actually a money pit that could wipe out your entire portfolio. We are going to break down the tax implications, the cash flow realities, and the hard numbers. Let's get into the data. Number 10 is Springfield. For the last 5 years, Springfield was pitched as the ultimate commuter paradise. Situated perfectly between Dayton and Columbus, it offered a value proposition that seemed unbeatable. You could buy a historic home with good bones for a fraction of what you would pay in a major metro. Investors flooded the zone, buying up duplexes and single-family rentals, banking on the idea that remote work would bridge the gap between local wages and rising asset prices. But here is the financial reality check that is hitting Springfield in 2026. The math is broken. The fundamental issue here is the disconnect between local income and asset inflation. Springfield's economy is heavily reliant on logistics, manufacturing, and retail, sectors that have seen wage growth stagnate, while inflation has eaten away at disposable income. When interest rates reset and insurance premiums climbed, the monthly cost of owning a home in Springfield detached from what the average local worker could actually pay. We are seeing a massive spike in days on market. This is the first sign of a liquidity crisis. Sellers are holding on to 2024 pricing psychology, but the buyer pool has evaporated. We are seeing price cuts stacking up, not just by a few $1,000s, but significant slashes as sellers realize they are trapped. For investors, the tax situation is equally grim. Many bought these properties assuming rents would climb indefinitely. But you cannot squeeze blood from a stone. If the local workforce cannot afford a rent hike, you are stuck with capped income while your property tax assessments are catching up to the inflated purchase price. That crushes your net operating income. Springfield is a warning sign that affordability on paper does not mean affordability in reality. Number 9 is Lorain. Lorain is a classic study in the danger of speculative investing. Located on the shores of Lake Erie, just west of Cleveland, this city has a gritty, industrial history rooted in steel and shipping. It was overlooked for decades until the recent boom, when investors scouring the Midwest for yield suddenly put Lorain in their crosshairs. They looked at the price per square foot, saw the proximity to the water, and convinced themselves this was the next big waterfront revival. But real estate is not just about the building. It is about the economy that supports the building. In 2026, the speculative fever in Lorain is breaking. Out-of-state buyers came in, slapped some gray paint on century-old homes, and tried to flip them or rent them at premium rates. They ignored the fact that the median household income in Lorain has not shifted enough to support these valuations. Now we are seeing the fallout. The cash-on-cash returns that were promised in those glossy investment brochures are turning negative. Why? Because of the uncalculated costs of holding aging inventory in a lakefront climate. The winter storms off Lake Erie are brutal on roofs and foundations. Maintenance costs are skyrocketing at the same time that insurance carriers are raising premiums or pulling coverage entirely for older homes. Tenants are struggling with utility bills in drafty homes, leading to higher delinquency rates. And here is the tax hack perspective you need to understand. When you have high tenant turnover and rising maintenance costs, your effective tax rate increases because your gross revenue drops. You're paying property taxes on an assessed value that is artificially high, while your actual income from the property is plummeting. Lorain is proving that you cannot gentrify a market without a corresponding increase in high-paying local jobs. The spread between investor expectation and reality has never been wider. Number 8 is Youngstown. Youngstown has been the poster child for the Rust Belt struggle for 40 years. We have seen the documentaries about the steel mills closing and the population drain, but recently, a new narrative emerged. People started saying Youngstown had bottomed out, that it could only go up from here. They pitched it as a blank canvas for revitalization. Unfortunately, 2026 is showing us that bottoming out is not the same thing as a recovery. The housing market here is revealing the deep structural scars that cosmetic renovations cannot fix. There were pockets of success, sure. Downtown saw some life, but the vast majority of the city is dealing with a phenomenon called the appraisal gap. This is critical for anyone thinking about buying here. An appraisal gap happens when the cost to renovate a home exceeds the market value of the home once it is finished. In Youngstown, you might spend $50,000 fixing up a house, but because the surrounding neighborhood is filled with vacant lots and tax-delinquent properties, the bank will only appraise it for $80,000. You are underwater the moment the paint dries. Lenders know this. That is why financing deals in Youngstown are falling apart in 2026. Banks are demanding higher down payments or refusing to lend on properties that don't meet strict condition guidelines. This forces the market into cash-only territory, which severely limits the buyer pool and depresses prices further. For the investor holding a portfolio here, the exit strategy is disappearing. You cannot sell to a retail buyer if they cannot get a mortgage, and you cannot sell to another investor if the numbers don't pencil out. Youngstown is a liquidity trap. Number 7 is Marion. Marion, located north of Columbus, was the sleepy, affordable alternative that suddenly woke up during the pandemic frenzy. It is a blue-collar town, largely reliant on rail and manufacturing. For decades, housing here was stable and cheap. Then the remote work wave hit, and people looked at a map, saw Marion was drivable to Columbus, and started bidding up prices. Now we are seeing the hangover. The primary issue in Marion is the PITI squeeze: principal, interest, taxes, and insurance. Local wages in Marion have not kept pace with the explosive growth in home prices and interest rates. A family earning the median local income used to be able to buy a nice 3-bedroom home comfortably. Now that same family is priced out, not just by the list price, but by the monthly payment. When you combine a 7% interest rate with a home price that doubled in 4 years, the monthly debt service is simply mathematically impossible for the local workforce. This has led to a stalling market. We are seeing listings in Marion sit for months. Sellers are confused. They look at the comps from 2022 and think their house is worth a fortune, but those comps are ancient history. The only buyers left are those who are extremely price sensitive. This is forcing a series of price reductions that is slowly dragging down comparable values across the city, and for those who bought at the peak, they are now facing the risk of negative equity. If they need to sell for a job relocation or a divorce, they might have to bring a check to the closing table. That is the definition of a market failure. If you want to stay ahead of these market shifts and understand how to position your portfolio to avoid these tax traps, make sure you're subscribed to Tax Hack Pro. We help you navigate the complex world of real estate taxes and finance so you don't get caught holding the bag. Number 6 is Warren. Warren sits in the Manning Valley, sharing a similar industrial DNA with Youngstown. It is a place of hardworking people and sturdy, older homes. But the investment thesis for Warren, that you could buy houses for the price of a used car and generate massive returns, is collapsing under the weight of deferred maintenance. This is the hidden killer of real estate returns, capital expenditures, or CapEx. Investors flock to Warren buying homes for $80,000 or $100,000. On paper, the 1% rule looked great. If you can rent it for $1,000 a month, it seems like a home run. But here is the reality of 2026. These homes are 80, 90, 100 years old. They have slate roofs that are failing, galvanized plumbing that is corroding, and knob-and tube wiring that makes them uninsurable. When a $100,000 house needs a $20,000 roof and a $15,000 HVAC system in the same year, your cash flow for the next 5 years is wiped out. We are seeing a wave of tired landlords in Warren trying to offload these properties because they realize the maintenance costs are eating them alive. But because interest rates are higher, new investors aren't biting. This creates a downward spiral in pricing. Furthermore, Warren's tax base is shrinking as the population slowly drifts away or ages out. This means the remaining taxpayers, the property owners, are shouldering a heavier burden to maintain city services. You are paying more in taxes for a property that is costing you more to maintain in a market where values are stagnating. That is a bad financial equation. Number 5 is Dayton. Dayton is a city with incredible history in aviation and innovation, and it has pivoted successfully in recent years toward healthcare and defense. It seemed like the stable middle ground. But Dayton fell victim to the BRRRR strategy hype: buy, rehab, rent, refinance, repeat. Too many investors treated Dayton like an infinite money glitch. In 2026, the refinancing part of that equation is broken. Investors who bought properties using short-term, hard money loans intending to refinance into long-term debt are finding that the new appraised values are coming in low, and the interest rates are too high to make the cash flow work. They are trapped in expensive bridge debt. This is leading to a surge in inventory as these investors try to liquidate, but the local buyer pool is wary. They have seen prices run up far beyond historical norms. There's also a neighborhood-specific dynamic in Dayton. The spread between the good blocks and the struggling blocks is widening. Investors who bought sight unseen, relying on Zillow maps, often ended up with properties in areas with higher crime rates or fewer amenities than they realized. The vacancy rates in these subprime Dayton neighborhoods are creeping up. Why? Because even renters have limits. When inflation hits gas and groceries, they consolidate households or move to cheaper areas. If you own a rental in Dayton and your vacancy rate ticks up to 15%, your profit margin is gone. Dayton is a stark reminder that leverage cuts both ways. When the market turns, debt becomes an anchor, not a sail. Number 4 is Toledo. Toledo is the glass city, a critical port on the Great Lakes. But Toledo is facing a dual threat in 2026: economic stagnation and environmental risk. This is a factor that very few real estate channels talk about, but at Tax Hack Pro, we look at the total risk profile. Toledo has some of the lowest price points in the state, which naturally attracts the bargain hunters. But those low prices reflect a lack of demand. The job market here has been uneven, with population growth essentially flatlining. But the bigger, silent killer for property values here is the rising cost of insurance due to water and climate issues. Great Lakes communities are dealing with aging sewer and water infrastructure that struggles with modern storm intensity. Basement flooding, sewer backups, and algae blooms affecting water quality are real issues. Insurance companies are pricing this risk into their policies. We are seeing premiums in Toledo jump significantly, which directly reduces the purchasing power of buyers. If a buyer has a monthly budget of $1,500, every dollar that goes to insurance is a dollar that cannot go to the mortgage principal. Rising insurance costs effectively lower home values. For investors, this is a line item that destroys the cap rate. You might think you are buying a 10% cap rate deal, but after you factor in the new flood insurance and the increased property casualty premiums, you are looking at a 4% return on a highly management-intensive asset. Toledo is showing us that cheap real estate is often cheap for a reason. Number 3 is Columbus. Columbus is the anomaly on this list because, for the last decade, it has been the economic engine of Ohio. Intel coming to town, the university expanding, the population growing, it was a boomtown. But that is exactly why it is in trouble now. Columbus is suffering from Icarus syndrome. It flew too close to the sun. The valuations in Columbus became detached from reality. In 2026, we are seeing a massive correction in the premium segments of the market. During the boom, developers rushed to build luxury apartments and high-end subdivisions. Now we have an oversupply of Class A units and expensive homes, just as the economy is tightening. We are seeing heavy concessions in the rental market, 2 months free rent, waived application fees. This softness in rentals trickles down to single-family home values. If it becomes cheaper to rent a luxury apartment than to buy a starter home, people will rent. Furthermore, Columbus homeowners are facing a property tax reckoning. In Ohio, counties reassess property values on a cycle. Columbus property owners are getting hit with massive assessment hikes that reflect the peak pricing of 2023 and 2024. Suddenly, the monthly tax bill has jumped by 30% or 40%. This shocks the monthly budget of homeowners and destroys the cash flow of investors. Columbus is still a strong city long-term, but in the short term, it is overpriced, oversupplied in the luxury sector, and overtaxed based on inflated values. The correction here will be painful because the expectations were so high. Number 2 is Cincinnati. Cincinnati has always been the steady, conservative aunt of the Ohio housing market. Old money, stable hills, river views. But in the zero-interest rate era, Cincinnati got trendy. The over-the-Rhine neighborhood and the surrounding suburbs saw prices go parabolic. In 2026, the music has stopped. The issue in Cincinnati is valuation exhaustion. Buyers simply cannot stretch any further. We are seeing a significant pullback in the suburbs that saw the fastest appreciation. Areas that doubled in value are now seeing inventory sit for 60, 90, 120 days. Cincinnati also has a unique geographic risk: landslides and terrain issues. Many of the desirable view properties are built on hillsides that require expensive engineering to maintain. As insurance companies tighten their underwriting, insuring these hillside homes is becoming a nightmare. If you cannot get affordable insurance, you cannot get a mortgage. This is rendering some properties functionally unsellable to anyone but cash buyers who demand a steep discount. For investors, Cincinnati has become a low-yield trap. The prices are too high relative to the rents. You are buying an asset at a 4% or 5% cap rate in a world where you can get a risk-free 5% return in a money market fund. Why would you take on the risk of tenants, toilets, and taxes for zero risk premium? Smart money is leaving Cincinnati, and that capital flight is causing prices to soften across the board. Before we reveal the number one city, the one that is the most dangerous trap for buyers in 2026, I want to remind you that your biggest expense in life is taxes. If you want to learn how to legally lower your property taxes and optimize your real estate portfolio, you need to subscribe to Tax Hack Pro. We give you the playbook the IRS doesn't want you to have. Number one is Cleveland. Cleveland takes the top spot because it represents the perfect storm of real estate risk. It combines every single negative factor we have discussed: high taxes, aging infrastructure, population decline, and rampant speculation. Cleveland has been marketed aggressively to out-of-state and international investors as the land of opportunity. Buy a house for $50,000, they said, but they didn't tell you about the tax rate. Cuyahoga County has some of the highest property tax rates in the state relative to home values. In 2026, the Cleveland trap is snapping shut. Investors who bought these cheap homes are finding that the city is aggressive about code enforcement and rental registration. They are getting hit with fines, repair orders, and tax bills that are disproportionate to the rent they collect. The population of Cleveland proper continues to struggle, meaning the tenant pool is not growing. You are fighting for the same tenants against thousands of other landlords. This leads to high vacancy and bad debt, but the scariest part for homeowners is the negative equity risk. In many Cleveland neighborhoods, if you pay market price for a renovated home, you are immediately underwater because the surrounding comparables, the distressed sales and foreclosures, drag your value down. If you have to sell, you are bringing cash to the table. We are also seeing a climate factor here. The lake effect weather destroys homes that are not meticulously maintained. The cost to keep a 100-year-old wood frame house standing in Cleveland winters is immense. When you combine high maintenance, high taxes, and stagnant appreciation, you have an asset that destroys wealth rather than builds it. Cleveland is the number one market to avoid in 2026 because the gap between the sales pitch and the street-level reality is the widest in the state. Do not get seduced by a low purchase price. Look at the total cost of ownership. Look at the tax bill. Look at the insurance quote. Real estate is not a game of buying low. It is a game of cash flow and solvency. In Ohio right now, the ground is shifting. If you own in these markets, you need to audit your position. If you are looking to buy, you need to be incredibly aggressive with your offers or sit on the sidelines. The days of easy money in the Midwest are over. Now it is about survival of the smartest. Make sure you're subscribed to Tax Hack Pro so you have the information you need to survive the shift. We'll see you in the next video.